What have I told you since the first day you stepped into my office? There are three ways to make a living in this business: be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
Good morning, or I mean, it depends. Good afternoon, good evening. It depends where you are in the world and actually when you're gonna watch the video. So, good Saturday to you all. Welcome back for another weekly market recap. To those, at least to those which actually survived the bloody Friday that we just got, which, quite honestly, it really put me in a good mood. Not because I do like or I do love to see the market plunging per se, but it's just a matter of volatility. I like volatility, and oftentimes, whether you find it right or wrong, volatility comes when things are kind of going south. So that's what we got, especially on a Friday. From the economic calendar standpoint, it was a very light week. And of course, we are still under a US government shutdown. So, not a lot on that side. We are going to completely skip that part and we are going to be focused a bit more on the charts. Now, just one thing to point out, I was curious and I was checking. So, it looks like the next CPI print is going to be released on October the 24th, 2025. So I guess again, regardless of the shutdown, it will keep on going ahead or it will come to a resolution. But it looks like they made up their mind that at least the CPI will be released. Now, as for the rest, really, there wasn't a lot. Like you can check Trueflation as for PCE, 2.40 more or less. CPI 2.2. Uh, GDP now it's not updated, of course. Now it looks like the market is pricing in almost 99% possibility of a cut to the next meeting, which is not surprising. We'll see. And as for the rest, there's really not a lot. So let's jump into the charts and let's look at what was the week which just ended. Um, Starting out with currencies, again, the DXY, as you can see in here, it kept on extending that rally, and conversely, of course, all the others came down a bit. Now, I remember last week I was a little bit on the side of yeah, I mean nothing really happened. We are still ranging after a tiny little move here and there. So we let's take the euro for reference. Right? We were pushing back into resistance, and again it was anticipated support broken, retested now as resistance, and we kind of rejected off of it, especially on Thursday, Friday. And then we've seen this week the continuation, which again was the DXY sweeping the lows, okay, some sort of a swing failure pattern here, getting back into the middle of the range, using it in here as support. So again, our assessment was, well, the surprise might be to the upside, considering the sentiment, the positioning, especially on the CTA side, right? So yeah, I mean, everything was confirmed. The dollar kept on coming up, and conversely, euro, pound, and even the yen. Do you remember? I was like, look, the yen tried to to break down off of this range, and it quickly got back into it. So, well, this time around, it looks like a legit breakdown of the yen relative to the dollar. So, even in there, we'll see. I think, you should also take into account what recently went on. Like you see, the DXY pulled back on a Friday while treasuries actually went up and the yields came down. So there's still that short-term relationship in between the yields being bearish, therefore treasuries being bullish, dollar being a bit bearish. All right, I don't think it's really something huge. I see it as a correlation, but which can be override. by many others monetary factors, so underpinnings and underlying dynamics of the monetary system. But more often than not, this is what you should expect as for the relationship in between yields, bonds, the DXY, and therefore the other currencies. The euro, at the end of the day, it bounced right off of previous resistance, and then kind of support in here, so I mean, this area was used in the past, was sensitive, so at least a tiny bounce off of this region maybe was due. As for the rest, dollar Canadian was weak before, and it keeps on being the weaker among these six. This time, even though Swiss franc took a little bit, it took a hit throughout the week, but then of course on a Friday he rebounded together with the DXY weakening. Now this is strange, or at least it could seem strange unless if you're not thinking about the actual structure of the DXY as an index, because you know when the dollar actually went up and then it pulled back, but you kept on seeing a lot of weakness, even despite the Friday's pullback in the DXY. The yuan kept on being particularly weak. The South African rand actually was, the weakest day of the week. It was actually on Friday, and even the darling of this park, the Brazilian real, had a very huge drop on a Friday. Look, now as usual, the Indian rupee is always the weakest among these six, and the Australian dollar took a pretty decent hit, right? Thursday and Friday. I The Australian dollar rate, I'm not sure how to assess it, because I would agree with the thesis that we might be at the beginning of a commodity super cycle, right? Although I have my reservation, especially on energy. But if you look at the metals, for instance, I guess especially precious metals, they are performing particularly well, and they always say that the Aussie dollar is a commodity currency because a lot of commodities are actually mined in Australia, and therefore, if you want to be able to acquire them, you need what? Well, the Australians are actually going to accept Australian dollars, and even if they accept another form of payment, once they receive that, they're gonna swap it in their local currency in order to be able to use it. So usually, when commodities perform well, you should expect the Aussie dollar to perform well. Uh, but I don't know. This hit that he took, it left me a bit like what might have been, and I didn't find the answer, especially because I was focused on other markets. So currencies, yeah, I do like them, but I mean, it's not my main focus. So let's have a look instead at oil. Oh boy, oil took a pretty serious hit, right? It went from 62 and 26 more or less on a open and closing base, down to 58.34. Well, actually, the close it's around 58.22. So not bad. I mean, it was a pretty decent move. The again, it's still it's fitting my bias for the short to mid term. And I guess last week, if you remember, it closed down in here. Now the thing was, I want to see what is going to happen at this level. And actually, quite honestly, if you remember the squiggly lines, I was expecting a direct test in this area and potentially a pullback. So now you might say, okay, it looks like, at least, at first glance, we completely blasted through the area or to support, right? And why might it be? Look, the point is that the way I see markets, the way I see price moving, it was kind of like this. So if we go down there impulsively, that leaves the door open for a bounce at first test, because the inefficient move to the downside in this case would leave a trail of unfilled pockets of liquidity to the upside, and it would make the entire leg down prone to pullbacks because of the inefficient delivery itself. So, the thing is that if you actually get the pullback ahead of support, and then you finally crashes into support, at that point I get a bit more skeptical. Could it bounce from here? I mean, yeah, it's like, there is no market which is usually moving in a straight line, but it's just the fact that what I was expecting or anticipating, it was, a test into here and then potentially a bounce in this inefficient leg in here, more or less. All right. But now, since we already kind of pulled back ahead of times and then crashed back into it, if we get a bounce, I would look at this area as a anticipated resistance now, because we already filled the move down, right? So this is what it might happen, in my view, if we have a pullback now. Of course, the move was volatile in all markets on a Friday, right? So usually when you have such weak closes for the week on a Friday night, on Monday, especially when I mean, it's more tied to the stock market, generally speaking. I'm not really sure about oil, but as a general rule of thumb, I would say I would expect continuation sooner rather than later. Like Monday, Tuesday, maybe another attempt lower, and then we could work around to put together a bounce. Um, Nonetheless, despite, you will need to judge it on the first 2 days of next week, but despite that, uh, the assessment overall, it keeps on being bearish in the short to mid term at this point. And potential bounces, to me, they would be just another selling opportunity, especially if you're trading it intraday, intra week. All right. So nothing new for me on oil. And I know people will say, but oil is getting pretty cheap. Yeah, okay. In my view, there is a difference in something which is actually cheap, maybe by many different metrics, right? And the actual timing that you want to apply in order to get in, all right? Something can be really cheap, but just because it is cheap now, it doesn't mean it's going to get cheaper tomorrow, next week, or next month before, the strong hands or a clear reversal in the actual trend will manifest itself. So again, I always default back to my thesis that you don't need to pick bottoms and tops, but just wait for things to be confirmed, wait for the market to show its ends, and then we could start thinking about buying oil, building up positions in oil for the midterm. But again, for now, not seeing it, right? Now let's have a look at the only one market, most likely, that was kind of positive for the week and closed down the week relatively good, right? If you look at a weekly candle, I mean, it's not bad. Yeah, we have a bit of a rejection off of the highs, but all in all, especially if you look at Friday, when everything was crashing down, as expected, right? Gold held up relatively better. Now, again, is it completely immune to potential, local tops at this area? Especially considering we are still tapping into the 4K level. Um, I mean, no, I'm not. I wouldn't say it's immune. Especially again, we have been talking about this a lot. That the risk, if you're holding gold like I'm doing, it's a bit increased when you look at the correlations, basically tending to toward one in between many different asset classes. Like, we have seen the equity market went up, Bitcoin went up, so every risk on asset went up, and at the same time, gold went up. So, if the correlation gets so close to one, you know, that just increases the risks that when something cracks, everything will crack together. But for now, it doesn't look like this is the case. Or again, I would keep on following my logic, as any further pause or consolidation has been used as some sort of a launchpad in order to keep on the bullish momentum. So in this case, you could look at this cluster right here, if you want to call it that, and say, you know what, up until the point we are above it, I'm not going to be bearish. I know there is a good amount of distance, like in between 4,030 to 3,900 in this case. So maybe you would like to zoom in and try to see if there is something else you could use as an invalidation point to establish if this move is done. I mean, the 4 hours are not actually bad. Like you've seen them, there's this sort of a liquidation, right? And then the market trying to bounce. So you could start to think in terms like, okay, now if we are ejected at this level and the market can't actually crack back up above it and keep on pushing, if instead we have a rejection here, right? Then at this point you might say, okay, at this point I might be a bit more hesitant to keep on betting on the momentum, right? And obviously, especially if you crack these lows right here, so the market is rejected, it comes back below these lows, then at this point you can really expect another 50, $60 type of a drop, I guess, right? Like getting back into the previous area of accumulation, filling in this delivery to the upside, which was kind of efficient to some degree. Maybe just this tiny little range was a bit inefficient delivery, but as for the rest, as you can see, it goes up, comes back down, goes back up, comes back down, goes back up, came back down into here, right? Filling in this tiny little inefficient leg. So, all in all, gold moved really, really good to the upside. I would I would maintain yet a bullish, potentially, subject to change or to be modified to uh, neutral type of a bias, but I'm still thinking it's difficult to be bearish gold, right? Especially again, I was about to hint at it when we were talking about the stock market, but since we're at it, the catalyst for the the Bloody Friday, it was the deal which was supposed to be arranged in between China and the US. Again, trade wars, tariffs, minerals, rare earths, and whatnot. So Chinese supposedly implemented restrictions or limitations on the amount of those minerals which could be exported. The US, namely Trump, took it as a step back in the negotiations, or it took like the opposite of a good faith, so to speak. So he came out saying, you know what, if that's the game you want to play, I'm going to impose 100% tariffs on all Chinese exports. And of course, the market didn't like it. Um, so yeah, but just again, but this, in my view, that would be another reason why some sort of a asset like gold should keep on performing well. It's not strictly about liquidity dynamics or whatnot, but again, it's just geopolitical risk, the globalization which is fracturing again, or at least that would be the narrative we would be put back in charge, right? And in that type of environment, why not having gold? It's no one else liability, so you don't have counterparty risk. So again, that plus still central banks accumulating that, and as we noted last week, it looks like now even retailers are coming in, as we've seen in the uptick in the ETFs inflows. So I don't know, but I think I'm gonna need to see more to call it, and to say that gold actually put in a local top, right? Again, it's totally possible, but I'm not seeing it yet. Could be totally different Monday, Tuesday, or Wednesday, who knows? But if you take a picture of this market right now, I would say we're still on the go. All right. Now, moving on to Bitcoin, which, yeah, Gee, that was brutal. Yeah, it's tragic dump. And again, I'm laughing because I was watching it in real time. I went out for dinner on a Friday evening, came back home. I was just, yeah, you know what? Before turning the machine off for the weekend, let's just check how the markets are going to close. I started out with futures, then I briefly had a look at currencies, and then I look at oil, and then I was like, wait, if oil is like this, if indices are like this, what could be on Bitcoin? And I remember watching all these price action in real time on a 5 minute time frame, and it was quite hilarious to see it. I think I was a little bit ahead of myself. Might be, the just the thrill for a lot of volatility, but I was posting in a server, and I described it as this is like watching little boy detonating above Hiroshima for for the pace at which the market was going down. I think we've been missing this kind of volatility into Bitcoin, and if you zoom out enough, right? I I don't know if people which came into the space just recently have witnessed that type of volatility in just one day, right? Um, but again, that being said, in my silly uh, way of having fun, if we set aside that for a moment, what do you think now about Bitcoin? Now, look, one thing might be that these type of move can only happen if you have a lot of degenerate people which are max leveraged long into this market. So technically, the move to the upside, it was a bit inefficient. We got above previous highs and we started distributing. Now again, you might have said, okay, so at this point I'm expecting a little bit of a pullback, but I'm sure nobody was expecting these type of action. Now you might say, okay, but none of that would have happened if it wasn't for Trump and for China and for all you know what came out of it. And I would agree, right? Um, Oftentimes, right, you can have a setup. You can have the table being set for something, or for the risk of something happening over something else, but you always need a catalyst. And there is a little bit of a duality there because, to some degree, you might say, okay, it's quote unquote, it's not my fault, right? If now I'm down, or if I was shaken out of a position, or if I suffered a loss, it's not my fault. I couldn't have predicted that announcement would have been done. All right, which okay, it's fair, but on the other hand, like the risk was there. I mean, the table was set, and again, if you check, and I talked about it this week, it was on a Tuesday. Like, just look at how price is behaving. All right. Now you can't read the numbers, but basically what I was looking at, it was the behavior of Bitcoin throughout this cycle. So from the lows that were put in after the FTX debacle, right? I was like, look, it looks to me like every time we took out a key swing, so a very crucial structural point or a structural swing, um, and every time we made new all-time highs in this run up in this bull market, the behavior the asset actually showed is that we always pull back a little bit. Now, of course, you make the average, and of course, averages are just averages. You can have a bit more, of moves above the average, below the average, which is why it's an average, right? So you could even calculate your standard deviation off of the average in order to have some sort of a measurement, or uh, a margin of error in your expectations. That is totally fine. But since these were the things happened in the past, so I was like, okay, so recently those type of pullbacks have been a bit tamed down. So, even if you don't want to take the average, um, well, I mean, 10, 15%, would you be on the high watch for it? And look, I mean, remember, Bitcoin was just at the highs in here, right? So it's not that I was looking at it and saying, well, you know what, it already pulled back 10%, maybe it will pull back another 5. No, well, we were at the highs on a weekly base. So this is when you need to pay attention. It's not when the move already happened, it's when something is getting particularly exuberant, right? But anyway, that was my kind of my take on it. Um, If you measure it now from the peak to the trough down here, it came down 20%. Oh, well, actually 19. Well, 19, I mean, it's kind of in line with the average, which was 21 and something. Surely it's a bit more than the 10, 15 I was expecting. Quite honestly, I mean, I put into the card a potential pullback in this region, which would have been a 10%, right? But uh, I wasn't expecting this sort of volatility, right? Nobody, I guess nobody was. So what about now? Look, we established that this area was breached because it didn't offer the type of support it was offering before. So we found support at the next relevant area to the downside, which was the origin of this move to the upside right here. So this cluster right here, kind of to the T. Although even in this case, again, just to prove you again that there are a lot of people which are over leveraged. All right. If you look at an exchange like Binance in this case, where you cannot use margin, I think, or if you look at others like Bybit, Deribit, and all the rest. But then if you check Coinbase, it's a different chart, right? We came back into the same area. If you check this one out, right? Still in this region right here, right? It looks like this region again held, and we didn't get back into this one right here, right? So again, leverage, of course, I think it plays a role because if you have a cascade of liquidations, that's just going to increase the price excursion because those people are going to be closed down off of those positions. And how do you close along? Well, you need to sell. So the selling pressure increase and increase and increase. Um, I don't know what's going to come off of it. I know for a fact that many people would have done what they have been trained to do in this environment on risk on assets, which is buy the dip, because of course it worked in the past. It worked for over the last 2 or 3 years, if not more. So yeah, was it a bid? Sorry, a dip that you wanted to buy? That I guess that's the $1 million question. I think conceptually, if you're looking at it from a technical analysis standpoint, if you see the market, kind of reacting to this level, which structurally you could dim it as a good level. So if you want to play the game of placing a position here, observing the bounce and saying, you know what, I'm gonna stick to this position up until the point I don't see this bounce being faded. Now, if you zoom in, it would be kind of like this. Now, discard the opens. This is really not something you should look at on this asset because they're all, by the way, they're all off. They're not actually following the the real timing of those. And the script is for another asset class, so naturally. But say you see the bounce, and if you have very quick fingers, you might say, you know what, in these 10 minutes, I'm just going to market buy with all the risks of the case, right? But volatility, spread, and all the rest, right? So if you see the bounce, then of course I'm going to hold to it up until this bounce it's completely negated, so to speak, right? Could this be a play if you're playing it for saying this is it? This was the massive liquidation. Now people are going to buy the dip, and I'm expecting the market to getting back to the eyes. Yeah, I mean, I think uh, it's not a bad play, right? Because it gives you a lot of room to breathe. Like these type of bounds, it gives you a lot of time and space to assess what the further developments will be. So not bad. I personally, I wouldn't do something like it again because I'm very conservative. So I would much prefer to look at it first of all, getting into a real market trading week. So Monday, Tuesday, when real markets are open, right? So you can monitor the ETFs flows and all the rest, and not just judging these bucket shop exchanges. Although again, a lot of them are actually being legitimized recently. Like we have seen Coinbase, we have seen Kraken, right? So I don't want to sound kind of insensitive or rude toward the crypto space. I'm well aware of what's going on, and this is a legit asset class. But I would just wait for the majority of the players involved in this market now to be present when decisions are taken, right? So to cut a long story short, I would wait today, Saturday, tomorrow, Sunday, and then opening up next week. If we can actually hold these levels, right, and starting to manifest a little bit of intentions, well, maybe at that point, you might want to try to go and find an entry. Now, this is just conceptual, right? It doesn't have to behave like these, right? To be fair, I wouldn't be surprised that even if it turns out to be a dip you wanted to buy, I wouldn't be surprised if we have another test around the lows, right? And then getting into the weekly open, we start to come back up, kind of like this, right? We'll see. Uh, we'll see. Could also be that, you know, uh, on a Sunday open at midnight, you immediately see this market shooting up. Absolutely, but again, this is why that I think there are just too many variables for me to be able to buy these dips, right? I'm not a deep buyer. I've never been. I play it safe. I wait for confirmations, as I discussed. I think it was just last week or 2 weeks back. I prefer to give away a bit of best prices available for a bit more of price information or market generated informations, right? So I guess we'll see. It depends a lot on what the rest of the risk on assets will do, so mainly the stock market. But for now, I would just say let's wait and see. Right, this is not something I would be confident judging upon throughout the weekend. Right, now let's have a look at yields. Yields came down as we were discussing in the beginning, and now I think again. In my view, this could be a change in behavior, or at least the beginning of a potential change in behavior. Now, if you remember, up until this point, whenever we have been talking about tariffs, tariffs were inflationary, right? Therefore, yields should go up. And if you remember, when tariffs were first announced back in April, this was the reaction on yields. They all went up, right? Now, you know, uh, it took a market a little bit to digest the information, to reassess, to work around what the further developments could have been. We have seen that tariffs were always announced, uh, to a large degree, never actually implemented. So over time, other forces got into the driving seat, namely, the labor market and whatnot, and therefore yields came back down. Now, this time around, instead, the initial reaction off of what could be another exacerbation of the trade war, or at least, one step farther or one step away from the resolution, from a deal in between the two main contenders, China and the US, we have an initial reaction, whereas yields actually went down. So, wait, if we impose 100% tariffs on China, it's not going to be taken as inflationary now. Now you might say that's nonsense. I mean, if those goods are going to cost you double what they were costing you before, how can not how can it be inflationary? Well, again, we have been discussing that. You know, price can go up in the short term, but consumers have a lot of many different choices, substitutions, or just stopping their purchases. And so just because something goes up in price, or it should go up, will it go up? if nobody is willing to buy it now at those new prices because of the tariffs imposed on it. So I don't I've never been convinced that tariffs were inflationary. I'm actually always been in the opposite camp. While I was saying disinflation, regardless tariffs. Tariffs is one off, and it took. I mean, I'm not saying I'm a genius. I'm I'm not by any stretch of imagination, but it took Powell like 3 or 4 months to realize that at the very worst case scenario, they would have been a one off. So could it be that now just because Powell said that, the market got in line? It must be true. I mean, it must be disinflationary or very slightly or temporarily inflationary because now Powell is saying it's going to be a one-off, and he's still convinced that probably he's going to keep on cutting rates. And again, the Fed funds futures market, it's still pricing in further cuts. So again, you see how sometimes narratives can change, right? And of course, conversely, bonds had a very good week and obviously a very good Friday, which again, for me, my exposure to bonds is always kind of the same. Like I got positions in gold, right? I was discussing just yesterday in a meetup with my good friend Silvan at longtermtrends.com. By the way, check the website out if you are into macro. Again, long-term trends. Uh, is it .com or .net? I think it's .net to be quite honest. But anyway, and he was like, yeah, why would you like to hold bonds? I mean, I'm not planning on holding U.S. Treasuries for 10, 20 years, right? Obviously, but in this environment, I'm holding gold, and gold overperformed the equity market. And still, getting back to the correlation, which is getting closer and closer to one, I would expect, and if the stock market take a hit to some degree, maybe a lesser degree, but even gold would take a hit, especially if we have some sort of a liquidity event. And in that scenario, what could edge your position? Well, that market which has been out of favor for the last 2 or 3 years, and the market which would constitute a safe haven type of flight. Because no matter what you think about the US government and the money printer and all the rest, the fiscal deficit, the insolvent, drunken Uncle Sam, whether you like it or not, the monetary system runs on this shit right here. Uh, all, the collateralized type of transaction that we got are all based on this. And when push comes to shoves, if you don't have the collateral you need, well, good luck having the funding you need, right? So people will scramble for collateral, which is why I think when you will have maybe a much pronounced downturn, you're gonna see the collateral or the thirst for collateral off the charts in the market, which is why I'm still keeping a portion of bonds just to hedge the risks I got on the long side on gold. All right, that would be the theme in my view. Will it work? Maybe, maybe not. I mean, we have seen like in 2021 or 2022 when everything was collapsing. I mean, bonds were surely coming down as well. So there was really no place to hide if not cash. Like cash is a position. Again, I know Ray Dalio says cash is trash, but especially when you had rates in the US at 5%, those money market funds, T-bills and chill, right? Turns out sometimes cash is not trash. And even Ray Dalio had to step back on that one. But again, I think what could it be for the next few weeks or few months? Um, on the inflation, uh, you know, from the inflation perspective, I just think that we are keep on seeing a little bit of one and the same. I think we are gonna keep on having this inflation, and therefore we we should expect yields to come down and bonds conversely to go up. Now, just as a caveat or just as an aside, if it turns out that the rate of inflation will be actually higher than what the market is expecting now, right? At that point, you might want to be interested in not holding bonds, but holding tips. So the treasuries, inflation protected assets, right? Now, I'm not going to dig into tips and how do they move and how the value of the underlying asset is calculated. I think you could just it's going to take you like 5 minutes. Just remember that tips should protect you better against you know an above expected rate of inflation realized because of how they are priced, right? When you buy a treasury, right, the math is pretty simple. You buy it, there is a face value. At maturity, you're going to get back your money plus the interests, which are stated at the beginning of when the asset is issued. With tips, you have the same component of a yield, but also the value of the underlying is changing depending on you know the realized inflation versus the expected break-even inflation, right? To again, in a nutshell, it's not precise. There are a lot more to discuss, but just to highlight the major difference there, and then you could check it out on your own if you wish to. All right. So let's move into stocks. I think I'm not going to cut anything this week. I'm just going to roll. But before we go, just for instance, since over the last 5 years, right, to close down the topic, right here, this is the performances on tips versus holding a 5 years treasury, right? Why is that? Well, because inflation was higher than expected. Again, 5 years, so that would take into account 2020 up to recent days. And we have seen what inflation was in 2021, 22, and to some degree 23 before actually topping out and starting to come back down decisively in 2024 mostly. So when you have a rate of inflation which is higher than expectations, tips will protect you better by the nature of them, right? Now, moving into stocks, let's yeah, okay. I see a red, right? Right off the gate. But yeah, of course, there's no point in denying that. It wasn't a good week. Funnily enough, the majority of the red was realized on a Friday, of course. The very redundant type of the logic here. And, you know, uh, I think that if you then check the behavior, right? This was last Friday. Do you remember we were saying, well, I mean, market went up, it closed not that bad on a Friday. And of course, Monday, up we go. We had a little bit of a retest back into the weekly open on a Tuesday for NQ futures. While, I mean, the S&P and the Dow, they, they actually came farther below the weekly open. But overall, um, we kind of held that region right here, right? And we kept on pushing. So we pushed up again, new highs both for NQ and ES, not for the Dow, all right? But usually remember these, when NQ is particularly stronger, the Dow it's relatively weaker and vice versa. There is, especially intraday, intra-week, there is some sort of an inverse correlation in those two, right? Which is why oftentimes, if I'm in Dow, let's say you want to get long the Nasdaq, I check the Dow and see, okay, what's the Dow doing? Oh well, the Dow is still pushing strong to the upside, so maybe I'm gonna wait to long the Nasdaq. Maybe it's better to see the Dow actually putting in a top. It doesn't matter even if it's a 1 minute chart. I just want to see the Dow pulling back, and then I'd be a bit more convict. Mm, well, let's say safe in long in the Nasdaq, right? But again, as another aside. So new all-time highs, and then we had again tiny little pullback on Thursday. So Friday started out good. We actually we keep on bouncing after the pullback, And the London session, European session was kind of in a range. We dipped, right? And then we tried to rally. And after the open, just an hour after that, we completely plunged on the back of the news coming out of President Trump. I think it was a post on Truth Social, right, which unleashed the Kraken, so, so to speak. But okay, so now what? Mm, Look, I think this is a pretty big bearish candle. But look, now it's always the same question, right? Who could have thought, right? Who could have thought? Because of course, you can't know that Trump is going to come out and saying something like this. But if you remember last week, while the market was bouncing and while we were expecting new all-time highs, there was some sort of a caveat for a potential, you know, much pronounced type of a pullback, right? Don't you remember that? Okay, I'm gonna just going to refresh your memory real quick right here, right? We left last week saying, wouldn't be surprised at all if we see new all-time highs this week. And then remember the last part of the week. And then maybe, just maybe, if we see the market pushing up, but the RSI is not following through, the stochastic is not pointing decisively to the upside, and we generate even a divergence on the MACD histogram, at this point we might be on the high watch for a potential deeper pullback in October, right? And lo and behold, what you got, it was, if you check the two ETFs right here, we were looking at them last week and the week prior to it. What we got is, yeah, both markets actually pushing up, right? But really, the RSI didn't make new highs, right? The stochastic didn't point decisively to the upside. It was still, as you can see, wiggling around, not really going up, right? And, on the MACD, what we were looking for, potential divergence on the histogram, even ahead of the pump. If you look at, Wednesday, Thursday, look, while the market is going up, right? Especially Wednesday, look at the read that you have on the histogram. It's very weak, right? So there was this divergence building up, and we eventually, with a catalyst, of course, we collapsed. Probably we don't have the counterfactual, but probably if we didn't have Trump talking, we might have just got back to the 21 exponential in yellow, right? And that would have been it, like we've seen in the past in recent times, right? But again, it's always a matter of what is my risk, right? I'm already expecting a potential pullback, or I'm seeing the table being set up for a potential pullback. And even if my worst case scenario is a pullback of what, 1.5% on the S&P, and on the Nasdaq it could have been some 2%, right? Do you want to be max long in that type of scenario that specific week? Maybe not. Maybe you want to be a bit more defensive. Or maybe when we break new highs, you want to trim down your positions, right? And say, well, you know what, at least, you know, even if the market actually pulls back, I got money in the bank. And I'm not going to suffer the same amount of drawdown or giving back the same amount of profits that I would have if I was just holding to my positions, right? And I might use that dry powder to buy back those same positions that I now trimmed and keep on riding, the uptrend. So at the end of the day, look, we came back to the green exponential, which should be the 55 in green, 55 exponential moving average on a daily time frame. And it looks like for now, we bounced off of it. Oh, at least we tried. We'll see on Monday, Tuesday. Um, it was a while, especially on SPY, since we didn't actually touch it. Q came close the beginning of September, and this time around we actually touched it. The changing behavior compared to the prior month is that this time around we actually closed below the 21 exponential moving average. Is it a doom sentence? It's the death sentence. If you check back, that alone, it doesn't constitute a sign of reversal. Like, look at this segment right here, right? We closed below the 21, we hovered around it for a while, and then we kept on pushing. Same for, SPY. Closed below here, immediately regained that, used it as support many different times, and we kept on rallying. What I added, if you noticed, in, what was that, cyan, uh, light blue, whatever you, what we got now as a risk, if you want to really look at the short-term momentum, is that we got I think this is the 8 exponential moving average. I know some people use the 9, but I went for the 8 because it's a even faster type of moving average in this case. We have the risk of a potential cross of the 8 to the downside of the 21. Previously, when we were looking, keeping on these moving averages analysis, right? When we got the market dipping below the 21, we actually never had a cross of the 8 below the 21. And the market overall was always able to resuming the upside trajectory. So let's try to get back in time and see when was the last time that we had the blue crossing below the yellow in this case. So 8 below the 29. Sorry, the 21. Huh, it looks like it was in here, February 2025. That was you know, the beginning of a much more pronounced pullback, right? And we got back to the 200 days moving average. I mean, of course, first we tapped the 100 days in white, and then, we didn't held and we kept on drifting down. Oh, of course, on top of it, then you got Trump coming in with the announcement of tariffs, and it keeps on going down and down and down. But, you see that overall, when you have dips or pullbacks where these blue moving average is not crossing to the downside of the yellow, those are still your buying the dip opportunity. While instead, when you see it crossing it, like in this case right here, right? I mean, sure, eventually the market went up, but it's just from the moment it crosses, you have a little bit more of a downside. So I think it's a good thermometer of the current momentum of the market, right? What else? That was August last year, right? You see the blue crossing below the yellow. Now the price is using the cross as resistance, and we have a bit more of a downside. So maybe you don't want to buy that dip right when the cross is happening, right? So I mean, again, it's just there are many other different examples if you keep on going back in time, but just an example on how you could manage risk. So this cross didn't happen for now. So what I would say is up until the point we can hold the 55, there could be another test into it. All right. Um, all the moving averages are still for now upward sloped. So up until the point you don't see a change in behavior in the sense of first, these two very fast moving averages are now crossed to the downside. You see the market trying to put together a bounce, getting back to retest the moving averages. And again, if you see them crossing while the market is trying to retest them and not being able to reclaim them, at this point you know that there is a confirmed weakness in the market. If that weakness is confirmed, right, by judging and moving averages alone, right, your next level of support would be the 100 days moving average. So you have another downside target, right? Now, of course, moving averages are not the all and behold, right? But it's just a nice visual representation, not only of the trend, but of the strength or weakness of a potential trend. So you might want to use them as a general rule of thumb, especially if you're playing with no leverage, just spot positions. You're buying a hold for the next 6 months, 12 months, or whatever, right? And at the same time, you could use them to the risk, right? I think, on top of it, what we've seen, and bear in mind, this chart is updated to the morning of what was it? I think it was on a Thursday. So while the market was going up, look at the CTA positioning on the Nasdaq. They were starting to sell again ahead of Trump, ahead of the news, what have you. As you can see in here, there was already a little bit of a selling pressure coming off of the CTA, so the computer trading algorithms. So again, that might explain why eventually, when you lose all the bidders, when those flows shift from being on the buy side or on being on the sell side, that's what happens. Now, is it all said and done? Again, it kind of like Bitcoin. I would wait for Monday first and foremost, and then we'll see from there. But sure, this is not something unusual. We have seen these sort of drops in the past, which is why I would again, first and foremost, I would advise caution, right? And just because the market had a little bit of a hiccup, I wouldn't necessarily sell everything and going hiding under a rock, especially because I was monitoring by the end of the day yesterday. It was really late my time zone, but I guess it was late evening on a Friday in the US. But I think I read a quote um, from what supposedly Trump has said, and immediately switched from, well, there is no more reason to have this meeting with Xi Jinping, and then, well, no, I think I'm actually gonna meet up with him again because we still have things to discuss. So we get back into that taco trade type of argument, right? Look, I don't know how it's going to end up, right? This is a negotiation, of course. It's impossible for me to have the information. I just think these two big players are going to keep on trying, to cut the best deal they can for their own side, and it's not going to be easy, and it's not going to be something which is resolved overnight. I think the only problem I see with markets right now is that we didn't have any type of a catalyst, right? We didn't have news because of the shutdown. We didn't have CPI, right? We didn't have unemployment data. We didn't have NFP, right? So at the first tiny, well, I mean tiny, relatively speaking, but at the first negative thing which was available, the market sold off. And that tells you a lot on the level of complacency that was present in markets, right? So that would be the main risk for me, right? But again, it doesn't really matter what I think at the end of the day. I've been keep on talking about risk for 3 4 months now, and at the end of the day, what I've always told you at the end of every single video, the trend is the trend. Don't fight the tape. The market will tell you, the market will give you signs that something is changing, right? Maybe what we are seeing right now is a preliminary sign. I don't know. Again, let's wait for next week, all right? But even if you don't catch the top, I think you're gonna have your chance to the risk at reasonable prices, even if we keep on having further deterioration and further pullbacks and drawdown in markets overall. All right. So that would be where I'd like to leave it for this week. Um, a bit on the shorter side, maybe slightly. I think we are hovering around an hour of recording, maybe because we skipped the the macro, the economic calendar type of a segment. But I think at the end of the day, for now, what people would be focused on is actually price action, especially when you have those spikes in volatility. Right. Speaking of volatility, yeah, I mean, the VIX. Wait, is it the VIX? Doesn't look like the VIX, to be honest. Let me check. Why is that? It is actually that. I would have thought it was higher than this, to be quite honest. Oh, okay, now it makes sense. It was in the wrong time frame. So we are up to what? 20, almost 22. Yeah, and even in this one, right? It, if you zoom in, you see that this was last Friday, right? And then look, Monday. Oh, wait, that was the prior week, which is even better because it was giving you signs that the VIX was coming up starting 2 weeks ago, actually, right? But this week was what? Okay, October the 6th. This is one. So you see it can't break this low and actually came back up on the 9th. And then, of course, on the 10th, it went up. But, if you were paying attention, you were looking at a VIX which was kind of trying to put together a move to the upside. So again, maybe another telltale sign that considering the VIX was, coming off of very low levels, like 14, which historically doesn't happen very often, right? So maybe another, you know, risk brewing. Obviously, I mean, this is nothing new, but the RSP, so the equal weighted index, I mean, I guess this is always diverging. It's just testimony of the breadth of the market. But yeah, so I I would say at the end of it, although you needed a catalyst, don't tell me you didn't have science post, which was a bit of a telltale sign that something was potentially brewing. Right now, of course, did we actually break some structural point, some relevant structural point with this drop? Let's try this one right here. So maybe this one. Yeah, that could be. Um, this one, but it didn't close below. So the Qs are actually still stronger relatively um, to the spiders. Do we have any type of trend line that we might want to look at? Let's have a look at this one. It's the most recent when the market really gained momentum. Well, if you look at it like this, it looks like we broke it. Do we have something similar for the Nasdaq? I would draw it like this. We are just there. Again, Nasdaq is a little bit less clear because it's a bit stronger, relatively speaking. But nonetheless, this is the first time that we manage to break a previous daily swing low, right? So we'll see about that. I would say in order to keep the momentum intact, you need continuation to the upside sooner rather than later. So, and therefore confirming it was just a dip. Otherwise, again, I think what I've discussed so far, it could be a good telltale sign for further downside to come. And I wouldn't expect a lot from the economic calendar even next week. So at the end of the day, it's not bad. Price is the best indicator there is, right? Especially because your P&L is dictated on price, not the news, not the indicators, and not anything else. So with that being said, we'll leave you off. Have a very nice weekend. Uh, enjoy your Columbus Day in the US, at least. To me, it obviously it doesn't mean a lot. And keep your calm. Just try to assess and judge things with a little bit of rationality. Don't don't give in to panic. And I would say the best thing to do would actually be turning off the news, like today, tomorrow, and potentially on Monday, right? Of course, except for this video, you should watch this one, otherwise you wouldn't know, right? All right, enough of jokes. Have a nice Sunday, and I hope you will be ready for Monday. Be nice and be cool. Needs out.